Welcome to ETF Edge, your go-to place for everything exchange-traded funds. I'm your host, Bob Pisani. Semiconductors are nearly 9% of the S&P 500. Can you believe that? It may soon overtake software as the largest subsector in the S&P 500. Strong tech earnings and the ongoing AI story is again responsible for most of the gains in the major industries, in the major indexes this year. And leading those gains are semiconductor. Let's talk to the man in charge of the largest semiconductor ETF, Jan van Eck, CEO of Van Eck. We're also joined by Todd Sohn, ETF and technical strategist at Strategic Securities. Jan, everybody knows you run SMH, the semiconductor ETF, $13 billion. Market cap weighted, up 10% this year. We're at a historic high, or maybe just shy of that. I look at the gains, though. I see 5 stocks here. I see NVIDIA, AMD, Taiwan Semi, ASML, and Broadcom. Most of the gains here. Here we go. And it's a narrow rally, even in the semiconductor industry. I'm going to put up what's down, but it's going to be surprising to people.
Yeah, if you look very narrowly, there's winners and losers over a shorter time period. And it's really interesting. The semiconductor, it's like a hardware sector, right? And it used to really go through boom bust. Even NVIDIA had 2 80% drawdowns. And so the question is, are we in the golden age of semiconductors where you have AI just driving unit demand and pricing power? And what we would focus on is the pricing power. Because NVIDIA's unit volumes didn't explode last year. It's just that these companies have huge competitive advantages, almost quasi-monopolies. Who competes against NVIDIA for GPUs is a big example, or Taiwan Semi, or ASML, the equipment manufacturer. So they've got great pricing power. They've got AI.
And I want to just show you, I want people to understand how lopsided this is. There's 25 stocks in the SMH, right?
Right.
Look at the big names that are down. I think only half of them are up this year. Look, Intel's down. ST Micro, Teradyne, Skyworks, Texas Instruments. There's a lot more. Explain these competitive moats, the wide moats that people use. That's the reason we're seeing this bifurcation, right? Explain this.
Right. Well, it's a matter of IP. So who can design a GPU, a graphics processor, better than NVIDIA, and what is their head start in terms of timing? So, and they're trying to build their moat by now having software services, and now they're building a cloud solution. But who can really compete with them? Or Taiwan Semi. It costs tens of billions to build a semiconductor fab plant. You could bet $100 billion to build one and compete, and then the risk is 18 months to 2 years, you're behind them in manufacturing. So that's a huge bet, and people aren't really making that bet. Now, of course, it's like honey. Competitors will come, right? So NVIDIA AMD is making a graphics chip. So they're going to try, but the lead is so big, and the profit margins are 50%. Right. The return on equity is huge.
And those of you who don't follow these fancy terms we use, moat refers to the competitive advantage that a company might have. So a wide moat essentially means they have a lot of protection against competitors, and that's your point. A company like NVIDIA has a very wide moat, protection against competitors.
High competitive advantage,
yeah. Todd, I want to bring you in here. We had a couple problems here. First, obviously, what we just talked about, growth is concentrated. Even in the tech area, you could say tech's got it's a narrow advance, it's all tech, but even in tech, it's a narrow advance. The other problem, of course, is the market is overall trying to price in rate cuts that the Fed doesn't seem to want to provide us any guidance on yet. So where are we here in this whole game? You're paid to watch flows, essentially.
Yeah, of course. I mean, you had a pretty good sugar rush in the fourth quarter of last year, whether you want to call it a catch-up trade or based on the idea of cuts, which there seem to be going away now. I think a lot of stocks are in extended positions. Semis are part of that, right? NVIDIA is some 50, 60% above its 200 average, for example. Now, that can continue, that can persist. Just be mindful of when mean reversion sets in, it can be very painful. I do like the idea, though, of viewing that the last 2 years were one of the more painful times in market history, right? You had the significant correction in 2022. Yeah. A lot of corners are still down significantly from that, especially in the thematic areas. So you still want to, if you're an ETF investor, look at the more cyclical corners opportunistically going forward.
So Todd, I'm not a technical guy, but the S&P was flirting with like a double top. And then it just broke through and made all-time highs. Yeah. I personally bought more equities after that. So I get the overvaluation. It's crazy in a way. It's very uncomfortable. But technically, we're okay, right?
Yeah, I think so. I look at 2 years of nothing as a great setup for the next, call it, 2 to 3 years, right? In the near term, next 1 to 3 months, there's going to be speed bumps. That's usually what happens. We had it last summer from July to October, but don't lose sight of the big picture that a lot of stocks are now breaking out over those highs from the last
So
year.
how do you address, again, this is a different way of saying it, but is the overweight a problem? How do you address the overweight in tech, particularly semis and software? We just put up something, and put it up again. The two groups together are 20% of the S&P 500. You throw in hardware as 8%. We got it almost 30% of the S&P is software, semiconductors, and hardware. There you go. There's the group for you. Is this a worry, or has this happened before? And in fact, this is the way the world always is in a rally. It is concentrated. It was 50 years ago with the Nifty 50. It was with internet stocks. Should we not be worried? As
you always say, markets are a voting mechanism. The market is now voting on semiconductors as the next big thing within the index, right? A decade ago, semis were 2% of the S&P 500. They're now 9%. They're catching up to software, which is the largest. You go back 20 years ago, it was Cisco and Intel. Right before the financial crisis, you had energy and banks were the top largest weight. They fell out of favor. You will have semis continue to gain market share, but just know at the ETF level, know what the product you're buying is, right? You go into a grocery store, there's 6 kinds of rye bread. There's 6 kinds of semi-ETFs right now, including Jan's. So you got to look at the ingredients. Is it market cap weighted? Is it equally weighted? Is it fundamentally weighted? That's really important now going forward.
I think what's benefited the winners in semiconductors, because it used to be, what you don't want to be is in an industry where everyone's producing a commodity, because then you have no commodity, you have no pricing power. And I think semiconductors, there were a lot of wars. You know, a lot of companies have lost. And so what SMH does is it buys the winners, or has, because of its large cap orientation. And so we're now, like Samsung is DRAM manufacturer, not in SMH. But also, there's not many DRAM.
Why is it not in SMH?
I don't know. I should know, but I don't know.
Should ask the CEO.
It's not
that's you. Let's ask the guy who runs it. Why is Samsung not?
Because that's not technically the part of the computer, right? That's the chip, right?
Really? No.
No, it's the memory. But anyway, but again, there's only a few winners.
They don't have a wide moat, particularly, right?
They do now, though. That's the point. But they had these big competitive battles over many years, maybe decades. And these are the winners. Yeah. And so, that's the situation.
I just want to go back to this idea and show you how crazy this is. The SMH is market cap weighted, so the bigger names, obviously NVIDIA is the biggest. It's up 10% this year. But you put up your nearest competitor, it's the XSD, which State Street runs, right?
Correct.
This is equal weighted, XSD. I know we put that on. There's SMH, put up XSD. It's down 7% this year. In fact, it's gone nowhere. It's 0 in the last year. So in theory, these are two look at that, there you go. These are 2 semiconductor ETFs. You say, oh, I want to buy a semiconductor ETF. This goes back to, you better be careful about what you're owning here. And maybe it wasn't obvious a year ago that this was going to happen. That's part of the problem. Like, oh, duh, Bob, shit, of course everybody should go buy, the SMH. But that wasn't obvious a year ago necessarily.
It's all about the due diligence. Now, I think from an ETF level, equal weighting your broader index exposure can make sense at times, right? The S&P or mid-cap, small caps. But when you want to make a more concentrated bet, like the semis or even like a biotech, I think that's when you want to know, maybe I should go to the market cap.
But now, in retrospect, we say, oh, wide mode, therefore, it was. Would it have been obvious a year ago amongst everybody?
Not to me. But I would say that this approach has been a long-term winner. I mean, SMH, since we took it over in 2012, is up 12 times.
Yeah.
I mean, that's just crazy. And it's the core, there are chips in everything. And it's just getting more so, right? In automotive, in obviously mobile, desktop, servers, there's chips everywhere. Yeah. They're in glasses, right? We were talking about glasses.
Well, one of the reasons this show was founded was because this was 7 years ago we started this show. The plethora of ETFs in sectors was confusing. Like, dividend ETFs. There was 20 dividend ETFs and people didn't know. The show was founded, this show, to help people make that choice. Here's a very good example of really a shocking performance differential. They're both called the semiconductor ETFs. And it's a shocking performance differential.
I think sitting here today, I could argue that it's very unlikely, and that's what this competitive advantage research shows, that you're going to get a small cap that can really compete against NVIDIA. It's just super hard. It has to be the giants competing against each other, and I would keep the bet on that not happening. But I don't know if you disagree.
You keep the bet on market
on this large cap bias.
With certain industries, I think it makes sense to keep going the market cap route. And I think this is a trend why you're seeing these more niche, concentrated type products come out again, right? Get rid of the excess small cap names and just stick with the 3 to 5 largest, whether it's using derivatives and whatnot.
It's the Cathie Woods thing, make big concentrated bets on a few things here, and you roll with the winners and the losers. I want to broaden this out.
These companies are gushing cash.
Yeah.
That's the difference. This is sort of, you can call it disruptive technology, but their financial profile is insanely different from ARK.
I want to broaden this out a bit. Your ETF base, Jan's is a lot bigger than semiconductors, folks. Van Eck is the 10th largest ETF fund family, I think it is.
Like
See, I know this and you don't. All right, never mind. Just believe me, trust me. Call me and ask me. But you have 2 big gold miner ETFs here. The traditional gold miner ETF, that's GDX, that owns all the big gold miners. And you have a junior gold miner, which I've always found intriguing, GDXJ, right?
Yep.
I know Matt Bartolini at State Street made a point about this a couple days ago. Gold ETFs have had outflows in the last year, and yet gold hit it at all-time high a little while ago. Gold's, up 7-8% or something in the last year. So this is an example, it seems, of investor interest not matching the direction of the markets. Gold price is up. You'd think, heck, people love that, and yet inflows have been down. Can you explain that?
Yeah, easily, because the ETFs are not the only thing happening in the world, right? So the big demand for gold bullion has come from foreign central banks. After the U.S. kind of sanctioned Russia, most of the rest of the world, we may not like it, said, that's great, United States, but we don't want to have our central bank reserves at risk of political wins in the United States. So there's been huge buying by central banks of gold bullion. U.S. investor, you're right, outflows out of the bullion ETFs, not a lot of interest in the equities and the gold equities.
And the investors are not as interested.
No interest. No interest.
Why? Usually, retail investors see prices going up. It brings some inflows traditionally. Why don't they care?
Well, you've got the NASDAQ 100 up 50% last year.
Yeah.
And now I get 5% on cash.
And so does Bitcoin compete? I don't know.
I think it does.
Bitcoin too. So your gold is kind of left in this abyss of where do I put it?
Like old guys, in their basement own gold.
Well, there's also been headaches even for those gold mining companies that really restructured and very great financial situation. Now they have political risk. So in West Africa and even in Panama, it's not just gold mining, but different kinds of resources, major political issues in getting production and profitability out of those countries. So there's now a premium for North America for lower political risk, and Australia, of course.
Yeah, okay. I want to move on. You've also got, Jan has a wealth of great ETFs. You have one of the largest oil ETFs, so oil services. OIH is the symbol here. And those who don't know, this owns all the big guys. It owns Schlumberger and Halliburton and Baker Hughes. But energy stocks have badly lagged the S&P as oil prices have been trending down since September to everyone's shock, post the Israeli-Hamas war. So tell us a little bit about what's going on there. I've sort of answered the question about what's going on, but
it's an unloved sector.
Yeah,
like Todd was saying,
earnings estimates are coming down for energy right now.
So I mean, look, the bullish case for energy to me is that you're at all-time highs in global oil demand. So it's 100 million barrels a day. That's still growing at 1 to 2% a year.
Wait,
not in the U.S.
The bullish case is what?
Oil consumption globally is at 100 million barrels a day, and it's still growing. It's not growing at NVIDIA rates. It's growing at 1 to 2%. But that's global. That's in a world where China is in a recession, let's call it. So other growth drivers in the world, and I look at Brazil and India, kind of those are my favorite countries to talk about, have not yet picked up the demand. So it's a weak demand, but it's a growing demand supply situation globally. And energy companies can do all right. There is growth in that sector because the world, remember, with depletion, you do need new discoveries, new services, new production globally. That's the best I can say.
And
the
supply
EMPs
is there. I mean, the bear case is supply keeps matching any. We're pumping 13 million barrels of oil a day.
The supply's there. The companies are arguably the next best cash flowing companies than the semiconductors. They're trading at double-digit cash flow yields for EMPs and sectors in the oil market. No one cares. No one cares. We should just take them private, Todd.
Well, that's why they still have great dividends, right? Because of strong cash flows.
I agree with you on the idea of the sector being unloved. You had pretty large outflows last year, and if tech were to take a hit at some point in this quarter, I would guess the more tactical folks rotate into stuff like energy or even healthcare, right? Those are the more unloved corners in our work, just in terms of look at the flow data.
Yeah. But I agree, it's unloved, despite the great yields.
Yeah.
And no sign that anybody's cutting any dividends at all, not a peep out of anybody, and that's what people care for. I mean, you look at some of these yields where, OIH, this company's 4%, 5%.
There's an integrated that made $3 billion in just trading energy last quarter. They're situated just to mid cash, and shareholders don't care.
You also run a small fund that owns uranium and nuclear stocks. This is NLR. People want to write it down. Nancy, Larry, Robert. Just hit a new high the other day here. It's a curious fund. It owns nuclear stocks, but also owns utilities. It owns Constellation, PG&E, Public Services. I guess these are utilities that own nuclear facilities, right?
Exactly. It's leveraged to the use. It's really a full spectrum play on if you think that use of nuclear is in a secular growth market.
Isn't the problem though, if just owning PG&E, it's a tough way to get leverage in nuclear on that. Isn't that the problem?
Yeah, the most leverage is a pure miners play, and one of our competitors has that. We think those companies are very volatile, and I'm not sure they make a fully diversified portfolio. So we include a healthy chunk of them to get the upside in a bull market, but there's also profits to be made now. Nuclear has been challenged occasionally on the operating side and regulatory setbacks, right? So there has to really be, I think for me, I don't know if you agree, Todd, but a real policy reversal. And you still have Germany shutting down all its nuclear plants, Japan being very hesitant. But I think investors are starting to say that's changing.
Yeah. The problem here, again, this is the example of owning stuff where you can move. The utilities get hit when rates go up, independent of whether they're heavily in nuclear. So it's hard to get that as a pure play. It's a problem we have a lot of these sectors where other things kind of influence them.
But it's not a utilities fund. These utilities are really leveraged to nuclear.
Any thoughts on?
Well, Jan mentioned the policy risk, right? The way that some of these funds are trading would suggest maybe the door is opening for that. But they're also such high flyers right now that any sort of mistake on that side will send them tumbling, I would say. So that's the risk going forward. And I think you're also starting to see volumes really climb for some of the uranium-type products. So that suggests to me that maybe we're getting a little overcooked, overdone in terms of the sentiment there. But it's the best place in energy right now, as the rest of the sector is still trying to figure out where it's going next.
Yeah, well, it makes some sense, though. I mean, hydrocarbons are, in theory, not going anywhere, but there's plenty of supply. Demand is a little lower, partly due to China. That's a tough one to play right now. I mean, and the whole, solar space is a tough one to play still. And wind and offshore has been tough recently. Nuclear, nothing irrational is happening here in terms of the prices. It makes sense that what little pieces there are in nuclear are outperforming energy, which is magnitudes of order bigger.
Yeah,
I think the support we need is just better global growth. And I think China's recession is really weighing on that. And frankly, I think we're doing better for the whole commodities spectrum. I know it's underperforming a lot of other things, but not really badly, considering the driver for global growth is really on its back right now and could be for a couple of years.
Yeah, China. A great discussion, folks. Wide-ranging. That's why we have all these people here. But that's it. That does it for this week's ETF Edge. My thanks to Jan and Todd. We've asked Todd to stick around and talk a bit more about ETF trends coming up on the ETF Edge podcast. And remember, you can see all of our shows on our website. That's etfedge.cnbc.com. Everybody have a healthy, happy, and safe trading week.
Get the ABCs of ETFs with the ETF Edge newsletter. Your weekly update on the hottest trends, expert analysis, actionable ideas, and exclusive insight from host Bob Pisani. Sign up now at cnbc.com/ETF Edge newsletter.